Welcome, Forex traders. Thanks for joining us. This is Chris speaking, and Apple Markets is going to present to you this webinar, Improving Multiple Time Frame Analysis. Thanks for joining us tonight. This is a live webinar on the 19th of February. Before we actually start with our topic today, please be aware of this disclaimer. The material here, this webinar is intended for a global audience, but it may not be suitable for everyone. To find out if it is suitable or not and other details, please visit admiralmarketsglobal.com, select your country of residence, and then contact an appropriate entity. Also, please be aware of the fact that you can use the same path, the same link here, admiralmarketsglobal.com, to request a copy of the risk disclaimer. It states that trading for exchange is considered high risk and may not be suitable for all investors and traders. Therefore, please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only, and by continuing watching this webinar, you agree with this disclaimer. All right. Thank you for your attention. There we go. So once again, this is brought to you by Admiral Markets. Take a look at the website for a lot of info regarding analysis, fundamental analysis, technical analysis, wave analysis, and then also a blog with Nenet's contributions regarding charts. There's a lot of info actually regarding trading and analysis, among other things, so highly recommend to take a look at that. So multiple time frames. First of all, we're going to take a look at why we use it in today's webinar. Many traders stick to single analysis time frames, and there's nothing wrong with that. First of all, I can see the value of it. First of all, if you of course look at single time frame analysis, it plainly means that you look at one time frame. Doesn't matter if it's 4-hour, 1-hour, daily chart. You just look at that particular time frame and do not deviate from that time frame when making decisions. Multiple time frame analysis, of course, indicates the fact that one is using two or more, which means a combination of a random combination could be 4-hour and daily, it could be 1-hour and 4-hour. That does not matter. It, of course, is a bit better if you stick to probably two fixed choices, so that one doesn't use at one point in time the daily and all of a sudden 1 minute, and then the next time a daily and a weekly. You want to have a bit of a structure in that, so if you choose 4-hour and daily, then it's better to stick to that. That is multiple time frame analysis, obviously, because we're using two multiple time frames. It could be, it doesn't matter, as I said, it could be a 1-hour and 4-hour or 50-minute and 1 hour. So what are the pros and cons here of using multiple time frame analysis? So why use it, first of all? Basically, we have more overview, right? We get a sense of the market structure on a different time frame and can see things that are maybe not obviously visible when looking at a lower or higher time frame. If we're on a 4-hour chart and it looks like it's an uptrend, but then we zoom out to the daily chart and we see that actually price has been falling quite sturdily before that, like this, and what we only see is this part, and we just see like this part on the 4-hour chart, we might get convinced that it's a very good buy, but then if we look left on the daily chart, we see a key level, and it actually turns out to be a very bad setup. So with multiple time frame analysis, we have more overview, we see more parts of the market structure, and therefore have more information, and therefore can be hopefully more wiser when making trading decisions. There are also some things regarding, for instance, the candle. We can see clearly with the candle who wins the battle. For instance, if there's a 1-hour breakout, is that breakout successful or not? If we zoom out to a 4-hour chart, we will see by looking at the candlestick how the candle looks like if there is a successful breakout or not. With that, I mean, if there's a resistance trend line like this, and price is on the hourly chart trying to push through it, something like that, is that a successful breakout? It's sometimes difficult to see. If we zoom out to the 4-hour chart and we see a candle that is looking like this, a pretty good size with no wick at the top and the close near the high, and a good side, most of the candle outside of the trend line, it's a good breakout. But if the candle is not that, but it's something like this, there's a big wick and the close is near the low, that's not a good breakout. So that's how you can basically use multiple time frames to have an idea about the validity, the strength of a breakout. So it solves that the breakouts and bounces. It solves the dilemma of reading what direction one could trade basically when you look at a trigger. With a trigger, I mean a trend line. A trend line is a typical trigger. What can be used by a trader to say, okay, I'm going to trade at the trend line, either a break or bounce, and I'll let price action decide. That's my trigger. This is the trend line is my line in the sand. It's my decision spot, and I will let candlestick patterns or candlesticks in general decide to be my trigger. So the trend line is where I want to react, and how the candlesticks form at the trend line is my trigger. At this moment, price is somewhere in here, and I'm not trading it in here. It can do anything it wants. I'm not trading it. But then if it does move up, it reaches my line in the sand, and I'll wait for the trigger. The candlestick pattern here will indicate the decision I want to trade. Now, that's not always the case. It's not always so that we can trade both ways. Let's say that we are in an uptrend, and we see a correction of a bull flag like this, and price is approaching the top of a bull flag. This is not a typical situation maybe that you would want to trade to the downside. You would maybe only want to trade the break, and you would forget to bounce back down and not trade that, and only look for upside. If it does happen. If it doesn't, there's no trade. That is probably more likely. In some cases, a trader could actually, in certain very strong key level decision spots, could even decide to trade it both ways. There is some disadvantage, and that is the paralysis of analysis. The fact that we get an overload of information. If we're looking at too many time frames, it could be overwhelming. And that is especially so if we're starting out with trading. Beginning traders, intermediate traders, and advanced traders. And this is one time frame, and here is all the time frames. Let's see, about 7, I guess, monthly, daily, 4 hour, 1 hour, 15, 5, yeah. Monthly, let's say, so about 7. So in this regard, with the beginning trader, it's better to stick to one and learn that, and then slowly increase as the experience grows. We can continue with taking more time frames, because then we can soak in that information. It's not necessary to say, by the way, that 7 is the best, even for intermediate or advanced traders, because it could be just too much information to look at and still too confusing. But my point is that as a beginning trader, as a beginning trader, you don't want to start out with 7. You want to start out with 1 and understand that chart. Then, when the time is ready, that this is okay, and you kind of master that, you can move on to 2 and start to learn that. Then I think optimally 2 or 3 is probably optimal. I don't think necessarily more is needed. There are, however, at the beginning of the week, I obviously do look at the month or weekly candle just for my informational purposes. So I do that, but I don't do that regularly, obviously, because I only look at it when it's needed. So I think that 2-3 is an optimal kind of balance for trading purposes, besides analysis purposes. So you want to avoid that paralysis analysis, because why? Because one time frame already gives a lot of information, and if there's 5 time frames pouring in with information, they're all too much contradictory. This one says that, the other one says that, the third time frame says this, the fourth time frame says this, and it just leads to too much misunderstanding, and eventually no decision is made at all. So how can we use these time frames? If you have any questions, by all means let me know, or comments. When do you use the multiple time frame analysis? We can use it, as I said, by identifying a line in the sand, a decision spot. I call it opportunity. It really doesn't matter how you call it. It's kind of like the moment where you say, okay, this is where I want price to go. At any point in time, we have, let's say, 20, 25 tradable currencies out of many of them. We have, let's say, five time frames that are tradable, right? And we have every 1 minute there's new information, or every so many ticks there's new information. So there's a ton of charts we could look at every single minute, and every single minute there's new information coming in. So how do we kind of choose what to trade? And this kind of like helps with identifying the charts we want to trade, this model. It also helps with understanding which time frames we use for every stage of that model. In my opinion, if you really want to boil this down to something simple, it is already simple, but if you want to even make it more simple, it's all about decision spot and a trigger, as I already said in the previous slide. When basically you look at a chart, and every time, as I said, there are a lot of charts, a lot of new things going on. Any trader could actually step into a trade at any point in time, right? At what point do we say now is a chart interesting, or when is not? When is not a chart interesting? Part of that answer could be strategy, obviously, because when using strategy, we kind of give a perspective, so we filter out a lot of things. But if we use a non-discretionary strategy, there's still a lot of grayness and a lot of moments where maybe not everything is very 100% clear. If it's non-discretionary and it's very fixed rules, then obviously, there's no doubt. If you're trading discretionary, it's not that simple sometimes. And many times there's setups that are potential setups, but how do we know they're good ones? And what I use is kind of not trading in the middle of nowhere. I don't want to trade in the middle of nowhere. What I mean is that if price is, if I see a trend line here and I see a trend line here and price is about halfway, that's what I call in the middle of nowhere. And I don't want to trade it there. I want price to reach a decision spot, which is either, in my opinion, using trend lines, for instance, and waiting for price to get at a key level before trading it. Because then I know that those are high probability setups. And anything in the middle of nowhere, the yucky kind of gooey middle, they are low probability setups. And I want to avoid those. So for me, I'm looking for decision spots. That's why in the trading room on Tuesday, Wednesdays, I'm always talking about what are key levels for me. What do I consider the main spots? What do I consider the main levels and trend lines and support and resistances? Because that's where I want to trade. At that point, I'm looking for price action to trade it, potentially. So I like market orders in that regard. Occasionally, pending orders if I really like a level a lot. But the probability has to be very high, because why do I not use a lot of pending orders? Because of the fact that there has to be a very high probability that the price will turn around at that spot. And there are occasions that happens, certainly. What happens is that if price is doing something and I expect price to turn around at this spot, I need to have a lot of confluence in that area before putting a pending order, because otherwise I'd rather wait for price to get there, because then I can use the new information still to my advantage to judge if I take the trade or not. If I have a pending order, then basically I'm saying, okay, I don't really have to see this information. I trust that that will be a good entry. In a way, it doesn't have to be so, because even if you have a pending order, you can still keep an eye on how price gets to your pending order. It's not totally true, but partly it is, depending if you're behind the charts or not, actually. Point is that I do use pendings, but there has to be more probability. So for me, decision spots together with triggers. So how do I filter which charts I'm interested in? I'm looking at trend, then I'm looking at the decision spots, I'm looking at any potential filters that could block a trade, I'm looking at the trigger then, and then after the trigger, I can enter. And the entry is still potentially different. For instance, let's say we have a trend line here, and I'm looking for a break. Price breaks through it, good break, so I'm looking for a long. But I don't have to take it necessarily right at the candle. I can wait for a pullback before taking it along. So the trigger is the candle, the break of the trend line, the candle breaking the trend line basically, but I can still wait for a pullback on a lower time frame and take the entry like that. So that's why I split these things into 5. When you look at time frames, one could look, for instance, at the trend. This is, I think, this is something that can, this is an example, first of all, and you can change it depending on how you want to trade, obviously. For example, a trend, what I like to do is 4-hour trends, look for opportunities on the 1-hour and 4-hour chart, look at filters on a higher time frame like the daily, weekly, perhaps on the 4-hour. Then on lower time frames, look for triggers and entries like 15, 30-minute chart, 1-hour chart. So you can see how, well, basically in this case, I'm using 1, 2, 3, still 5 time frames. That is quite a lot. The filters, one could easily, I guess, get rid of the weekly if you're trading the 50-minute chart. If you're trading the hourly chart, you could then get rid of the 50-minute chart. So you could get it down to 4. You could even get rid of the weekly and just keep focusing on 1-hour, 4-hour daily, for instance, like that. This is just one way. It doesn't mean that it has to be always 3. In fact, 2 time frames is also, depending on how you trade it, just as good, I'm not saying. In my opinion, probably, as you can see, I'm more oriented to using multiple time frame analysis than not. However, if you want to keep things a bit simpler, then I don't think there's anything wrong with 2 or even 1, but you kind of exchange simplicity for less kind of overall overall view, or less ways to capitalize on more information when using this multiple time frame analysis. For the trade management, of course, we can use multiple time frame analysis as well. Matus has a question on filters. What filters are you looking for on the daily, weekly time frames? Basically, I will look for candle highs and lows. I mean, if I'm trading on a 15-minute chart, I'm not ought to be careful of the daily high. If I'm trading a swing trade, I'll be careful of the weekly high, or at least trading right in front of it, like 1 pip in front of it, for instance, or a few pips in front of it. I mean, when it's close to that level, you want to be careful, maybe wait for a break or a bounce, for instance. Big daily tops and bottoms, like fractals, even trend lines, for instance, and that's about it, I think. Basically, even divergence is something to be aware of course, something that could take long before it plays out. So it's not something that might be very actively used immediately, but something that is good to keep in mind. Maybe not for that week, but next week, because those things can take time to play out. Fibs, yeah, even fibs for filters, absolutely. Could be a filter as well, because a long setup, indeed, right in front of a key 50 fib resistance is also something you want to be careful of. So fibs too, indeed. Fibs are good for triggers, but also for filters. Totally agree. So you want to be careful with, of course, not necessarily over-filtering, but these things are important, and we've got to strike a balance, not to use too much. I wouldn't add anything to this, otherwise it will get too full. This is already a lot, and striking the balance between filtering and keeping enough setups is something that takes a bit of balancing always. One more explanation about opportunity filters and triggers. Filters basically are things that on the chart that will stop us from trading. So if, for instance, price is in a downtrend and let's see, I would like to short it, but actually there's a bigger swing high, swing low here, and we fib that. There's a 50 fib right here at the green line. We don't want to short right in the 50 fib, so that would be a filter. We don't trade because of that 50 fib. So it's canceled, that idea. So we filter it out. Opportunity is basically, it's like a line in the sand. So for instance, we're in an uptrend and we see a bull flag correction. The opportunity would be the trend line, the top of the trend line, the top of the bull flag. And then trigger is when the trend line breaks. We're in that uptrend. We have the bull flag and the trend line breaks. And the trigger is when it breaks, for instance, with a good candlestick or, a good candlestick pattern or candlestick. That could be the trigger then. Or price isn't breaking through the bull flag, but it's pushing through a fractal. That could be a trigger. So trade management, basically support and resistance, momentum and trend, and patterns I think are important to understand the market structure in general, by the way, actually. These are good things. This is basically these three things we can use for understanding where are the decision spots, where are the lines in the sand. So by using support and resistance, momentum and trend, and patterns, we can kind of judge where those lines, lines in the sand are, or DS, decision spots, right? Then when we have those, we can decide how to use triggers at those levels. These are important things. So we can also use them for trade management, and we can decide on exits, market exits, trail stops, hard TPs, soft TPs, closer TPs. I think I meant, I'm not sure what I meant with that actually, sorry about that. I think I meant when price hits a soft TP, we will put on a new TP, probably. Well, anyhow. Trade management, very important with multiple time frames too, but I would want to caution, actually more caution you with that. If you take a trade on one time frame, I would not, unless you're entering, let's say you're entering, you have a trigger on the hourly, but you're only zooming into the 5-minute chart to enter, as soon as you've entered, move away from the 5-minute chart, I think. Unless you have a special strategy that allows you to capture a very quick momentum burst, fine, but then maybe the trigger is not the hourly chart but the 5-minute chart. I'm not saying there cannot be exceptions, but most of the time what I mean is you want to be careful with zooming in too much. If you take a trade on a 5-minute chart, don't zoom into the minute chart. The point is that you'll get nervous about what's happening on the lower time frame. You'll get antsy and you'll make decisions based on small movements, and you'll get knocked out of the trade, and when you actually didn't take that trade on that time frame. It's better to stick to the time frame that you take the trade, or even zoom in at one time frame higher, so you have the patience and you can relax and you can stay into the trade up to the target that you have planned. Otherwise, if you zoom in, you'll see more noise, you'll see more action, you'll see price moving higher, up and down more faster, and that's just going to get at you and hit the nerves and kind of be tough for the psychology. So that's what I would want to help you with. So in that regard, moving up a time frame could even make it easier. That is actually the first two things I already talked about, paralysis of analysis and zooming in and out. You don't want to do that too much when trade managing, neither when analyzing. You want to keep it more structured so that it doesn't cause emotional reactions. You want to kind of keep that process and procedure in a way, that structure, so that, because anything that kind of can tip you over the balance of the psychological balance that we need to keep equilibrium could be bad. If we get kind of out of balance, we look at a lower time frame and we get regret that we didn't take a trade. Before we know it, it's a slippery slope, and before you know it, you took a trade out of the blue just because kind of like as a reaction, as a revenge trade or whatever. So we want to keep it more structured, and zooming in and out is good, but we don't want to overdo it too much here because it could be bad. Also, monitoring the chart too much could be bad because we get enticed to make decisions that are not at the right point. When we have, for instance, let's say you have strategies saying we're looking at the hourly chart to make decisions, then really there's no need for us to look within the hour to that chart, right? We just keep it on the 1 hour chart, and the earliest we need to do anything is the next bar, because there's nothing else to do. So we wait for the next bar, and even that is probably early, because depending on how your trade management is exactly, you might want to wait a few candles to make a decision. But if your strategy does dictate that you're looking at candle highs and lows every hour, then that would be appropriate. But within that hour, it wouldn't make sense. Other problems: not knowing which time frames to use for trade management. Be careful of that. Really consciously think about the time frames which you use for trade management. I think it's better to use the same or higher time frame than the entry, most likely, but there could be exceptions. I don't want to say it's an iron cast rule, but I think in general it is probably better. Unless you're going for a quick hit and run, let's say you're going for a trade that you know that you're probably aiming for less than R1-to-1 R2R. In those cases, maybe looking at lower times, a lower or same time frame is maybe better. Other problems: not knowing how to use multiple time frames, or using multiple time frames too much. It's a bit the same. So you want to use it wisely. You want to use it appropriately. You want to know when to use it, how to use it. I hope I've given you some tools how to do that. And you don't want to just overload yourself with too much info, because it just doesn't help. You want to even perhaps limit certain tools and indicators to a certain time frame, like for instance moving averages. You might decide only to use the moving averages on the hourly chart and remove all the other moving averages, or use more on 1 hour and only one on 4 hour, for instance. Those kind of things. You could decide to only use the oscillator on the 4 hour and daily, but not on the hourly, because on the hourly it doesn't play a role for you. Just to give you an idea about that. So I only have 2 minutes left, so just not too much. But maybe any questions still regarding what I mean with TOFTM, which is the abbreviations of those things: trend, opportunity, filter, trigger, entry method, the first letter of each. So when I look at the market, basically, right, let me quickly get this here. Typically I would be looking at multiple time frames and looking at various elements of that to do analysis, and basically scanning the market on a few pairs, few time frames, to see which currency pairs are interesting for me to trade that week or that day. That's kind of like a general analysis. And when I've kind of zoomed into a pair, then I'll use the TOFTM model, and I'll use more kind of specific strategy for tackling that currency. Now, it depends if you're using multiple. If you do use, that would be useful if you do use multiple currencies. If you don't, then of course you're just doing, and you're only trading one currency, then it's simple. You would just look at that currency, obviously, or those two, right? That would be kind of an extra, less steps needed in between. All right, so I guess the best thing to do, if you're more interested in this, how I do this, I use multiple time frame analysis anyhow all the time in the live webinar, so I suggest that will probably be the best to take a look if you have time, or if you can't make it in the morning because it's annoying time. There are recordings on the Animal Markets YouTube channel, and I think you should be able to find it there. So with that said, let me hand over the charts to Nennet, and thanks for your attention.
Chris, lovely presentation. Yeah, I will continue now to show you basically what we can do with multiple time frame analysis. And I will be presenting you a few ideas to basically watch for when you're trading multiple time frame analysis. So in the first, for starters, we need to talk about few things. So I will be quick with this. So MTF refers to multiple time frame, and if you want to use multiple time frame, you need to align the momentum and you need to align the trend, because if there is a trend, there is momentum. Then if there is momentum, there should be a loss of momentum for a retracement, unless we are doing a breakout trade. I will explain that in detail. So multiple time frame trading analysis refers to the same pair on different time frames. Okay? And we already know that trend exists on each time frame. So we need at least 3 scans of various time frames to be able to capture the trend, momentum, and cherry pick the entry. Okay? Now, first of all, I will explain a little bit about various time frames: 1 minute, 5, 15 minute, 30 minute, 4 hour, daily, weekly, and so on. Now, obviously, this is for traders who want to use only a single time frame. And now, if you want to switch over to multiple time frame, you will need to know first what single time frame analysis can do for you. 1 minute to 5 minute is called scalping. So if you want to trade 1 minute or 5 minute, you will definitely be scalping. Advantages of scalping is definitely that the first one is you will have a lot of chances for entry, especially if you trade 1 or 2 pairs. You will be given a lot of chances to trade, even if you trade with a single pair. Also, there is less chance of losing trades, because you will, if you scalp, then if you want to make 5, 6, 10 pips, most of the time you will be doing that. Unless you aim for 15, 20 pips, that's something different. And there is no overnight risk, because scalping is a little bit faster than every other method, except if you want to go with extreme scalping. That is 1 minute scalping. But definitely there is no overnight risks for your trade. Now, disadvantage of scalping is you have more cost to pay, because it's about spreads. If you want to make 6 pips, very often you will need to give 1 or 2 pips for the spread. So it's not very good from risk to reward ratio. It's also mentally difficult, because you can change the trend, you can change everything, but you cannot change the news. For example, we saw what happened with euro dollar today. It meant to break 1450 level, which basically is a huge obstacle for 1530, 35. And I did the analysis, but later it came straight to POC, straight to 40.00 and 30.90, even going back to test 30.55, 58. So that is not up to us. Sometimes if you scalp, you need to be prepared for a bias change and to basically switch over from longs to shorts and shorts to longs. So it's not that easy. Limited profits also. If you want to scalp, well, again, you probably will not be able to capture 30, 50 pips in a single move. You will be probably taking 1, 2, 3, 5, 10 pips out of the market, and definitely scalping is only for people who have the time and who are not afraid to basically get in with a little bit more of a leverage than it's normally. 15-minute scalp swings, it's something that is my term, which I use for qualifying trades, which are basically something in between scalps and intraday position trades. Okay? Advantages of 15-minute trading, generally I call it scalp swings, and most of traders who trade 15 minutes are basically trading the time frame during the day. So it's an intraday time frame, but it's something in between scalping and intraday positioning. You will have a lot of trade opportunities, definitely. You will also have less chance of losing trades, no overnight risks, but slightly bigger targets than scalping. Again, you will need to pay for the spread, and you will need to be constantly close to your monitor, because 15-minute trades, same as 5-minute trades, they require babysitting the trade. You cannot just enter and then leave your computer, because if you do that, the chances are you will lose. The chances are you will lose, definitely. So you need always to constantly babysit your trade. Okay. 1 hour intraday is, for me, in my opinion, is the best suitable for intraday trading, unless you want to scalp here and there. Usually, if you make intraday positioning, it's great because it's suitable for full-time, part-time traders. You can also have 3 or 5 or 4 or 5 pairs simultaneously opened and looking for an entry, so you don't have to babysit. You have less chance of losing trades, again, because you're doing an intraday time frame. Bigger targets, definitely 30, 20, 30, 50 pips, even more possible. And intraday positioning gives you the chance to use trailing stop. After 15, 20 pips, you can use trailing stop. Disadvantages you will use, definitely you will have overnight risk, because sometimes things can change during the night. You also need to pay for swap if trading multiple pairs, and usually swap is negative. So if you carry the trade over the night, the midnight rollover, you need to pay for swap. On some pairs, going long and short, it's different, but for most pairs, swap is negative, so you need to be able to pay for swap. Also, disadvantage is that it's called exiting overnight. You know what I was telling you a couple of times before. Very often, if you trade Asia session and you leave your trade during Asia session, it can be good for 20 or 30 pips of profit just to see a stop loss once you wake up for London session. There are a lot of fake moves during the night, especially during Frankfurt Open, Frankie Fake. Sometimes the pairs will not behave the same manner they did in New York and London session, and if you want to keep your trade in profit, very often you need, unless you're trading without stop loss, which I definitely don't recommend, you need to be able to wake up during the night and then, well, pay attention to your PC or laptop or, I don't know, mobile phone to see if your trade is in profit, and then close it. Because very often you will see the trade in a profit, then once London opens, bang, bang, there goes your money. Stop loss has been hit. So intraday positioning is great, and definitely I recommend intraday positioning for all type of traders, even for new traders, because you will have a really less chance of losing trades compared to, I don't know, for example, extreme scalping, which is really, really hard, and you do that with a really low stop loss. 4-hour daily time frames, I particularly don't trade 4-hour and daily. Yes, it's suitable for part-time trading or limited investing, because you won't be making entries so often. You will have bigger targets. It's good. You can use trailing stop. It's also good. You can use pending orders, which is also good. But disadvantage is overnight risk. Again, you need to pay for swap. It's especially if the swap is negative, then very often you will see that you're losing the money just because of the swap and the pair is going nowhere. So it's again a little bit, it's a disadvantage, definitely. Then macroeconomic risk. Things can change during the day, during the night. We saw again what has been happening with euro dollar, and definitely the pair is fundamentally driven. One good news for euro, bang, euro dollar goes up. Greek exit talk, bang, 100 pips to the downside. Dollar FOMC dovish statement, bang, euro dollar goes up. then again talk of Germany rejecting Greece plan, bang, euro dollar goes down. Isn't that a little bit, you know, boring, right? So if you trade on intraday, you will either lose or win, right? So you will either lose or win. But if you trade 4 hour and daily, you really are stressing out yourself. You will see your trade in a profit, then after, I don't know, 30 minutes, you will see your trade in a losing, then again you will see your trade in a profit, losing. So it's good if there are no fundamentally driven events. But as long as there are fundamentals which are moving the pair, it's not good to look at all, really. Then my advice is, if you want to go on 4 hour and daily, pay attention to your screen each 4 hours, and I don't know, make your entries, set and forget. It's called set and forget. You make your entry, you make your target, you make your stop loss, so it will be either win or lose. Okay, there is no scalping, there is no exiting. Either your target will be hit or you will lose. It's really stupid to make 100 pips stop loss and to grab only 20 pips. It doesn't go like that. So at least 1-to-1 risk to reward on 4 hour and daily. Yeah, a trader is asking for 30 minutes. Yeah, I was talking about 1 hour intraday. I was not mentioning the 30 minutes because 30 minutes is basically, I don't use 30 minutes unless I do it for breakout trades. But M30 is also a sort of intraday positioning. Weekly, monthly, what can we say about weekly and monthly, which you probably know? You know everything about weekly, monthly, and I'm not sure that any one of you is trading using weekly or monthly candles. First, it's not trading. It's called investing. Now, it can be a strategy to raise your portfolio and to, I don't know, to save, let's say, quoted save, some income if you know what you're doing. But also, you know, it's not trading. It's called investing, because you make 1 or 2 trades during the year and you wait for the trades to develop. It's not prone to intraday movements. So intraday, these kind of things which are getting in on our nerves, such as Greek talk, Greek exit, Germany rejecting the plan, Germany accepting the plan, so on, that doesn't exist if you trade weekly or monthly. So you're not definitely prone to any news. It's totally news-proof. Fewer transactions, less spreads, but trades take weeks, months, years. It can be good for a trader who doesn't want to look at a chart. Usually traders who are trading weekly or monthly pay attention once per week or once per month to see whether their investment is in profit. Now, the biggest disadvantage is macroeconomic risk. That macroeconomic risk is a really huge disadvantage, because all of those macroeconomic risks can happen during the course of that investment. Also, a huge flaw for a investment is it doesn't use any stops, or there are huge stops. Usually it's a time stop or equity stop. Usually people who want to trade on weekly or monthly time frames, they enter with a low position, and they don't use any stop loss. They can use only equity stop. Once their equity drops to, I don't know, 2 or 3%, they can definitely, or 10% or 20%, it depends from a trader to trader, they can close the trade manually. Really, using stops on weekly or monthly candles, it doesn't make sense. Swap, also paying for swap if trading multiple pairs. And even if a trader wants to trade a single pair, he still or she needs to pay for swaps. It's very slow. Trades take weeks, months, years to develop. Those are usually large swings, okay, large swings to the upside, downside. And there is usually 1 to 2 trades per 6 months or per year. Bigger accounts, you definitely need a bigger account for investment. and there will be definitely losing months, less, needless to say, losing years. You know what happened to dollar Swissy or euro Swissy investors when SMB decided to drop the floor to unpeg from euro. All of those investments in the last year and last 3 years have been killed. So huge macroeconomic risk, and usually trading without stop loss. Now, why should we definitely use multiple time frame analysis? So for all of you who cannot find themselves into a single time frame trading, and for all of you who are still looking for another approach to trading, there is always multiple time frame analysis. Multiple time frame analysis is totally different from one single time frame trading, because you will be aligning the trend, higher time frame with lower time frame. You will be aligning the momentum, okay? Aligning the trend, aligning the momentum. Then you will be aligning the targets, looking for higher time frame targets. You will be aligning the stops, using stops on entry time frame, and you will definitely be able to cherry pick your entries, okay? So you're using higher time frame trend for trading the price. And multiple time frame analysis is usable only within trend trading. The larger the time frame, the more likely an important support resistance levels would hold, okay? Now, why also to use multiple time frame? It usually takes 3 time frames in succession in the analysis. It's either 4 hour, 1 hour, 50 minutes, or daily 4 hour, 1 hour. The highest time frame captures the trend. Next time frame captures the momentum. The lowest time frame gives us the entry. Okay? That's the point in multiple time frame analysis. In order to be able to pick the entry, you need to know the trend. Okay? You need to know the trend. If the trend is to the upside, next lower time frame needs to have also the momentum to the upside. Then next lower, the lowest time frame of all of these, M15 or 1 hour, needs to lose the momentum to have a retracement to be able to give us the entry. I will repeat this once more so you can definitely memorize the logic behind this, what I'm speaking about. Okay? You need to be able to capture the trend. Let's say the trend is to the upside, okay? So you have to define the trend to be bullish, okay? Bullish trend means that the prices are going upside, okay? They're going to the long side. Next time frame, lower time frame, so let's say we are using 4 hours to capture the trend. So 1 hour time frame captures the momentum. If the trend is to the upside, momentum needs to be to the upside on the lower time frame, 4 hour or 1 hour. It still needs to be bullish. And if you want to capture the entry, the exact entry, you need to zoom into lower time frame and cherry pick the entry. And you need to have the loss of momentum, because you will be buying when the price drops. You won't be buying when the price is high unless you're making breakout. Now we don't talk about breakout, we are talking about normal trend positioning. So you want the price to pull down, pull back to your level, which can be seen on 15 or 1 hour. Okay? Now the question is, I see the question, Nenad, could you show me previous slides for the second? Yes, this is previous slides. I will go later through these slides. And if you want to trade like this, you will be using either 4 hour for trend, 1 hour for momentum, and 15 minutes for entry, or daily for trend, 4 hour for momentum, 1 hour for entry. It doesn't matter which one of these you use. It can be good, definitely, but you need to know what you're doing. Jan is saying there is a book about it, Trading for a Living by Dr. Alexander Elder. Yeah, probably. I haven't read the book, but probably I haven't invented, as I say, warm water. So probably there are also some other traders who know about this, but definitely this is the principle of multiple time frame analysis. To be honest, guys, if I see a huge strong trend, then I would prefer this 4 hour, 1 hour, 15 minutes. If I don't see very strong trend, but I still see the trend, then we can go with daily 4 hour, 1 hour. So it matters only if it's a stronger trend, because if it's a stronger trend, this can give you this can give you more entries than this one. So basically it depends whether there is a strong trend or weak trend. If there is a weak trend, then you can go with this. If there is a strong trend, you can go with this. Now I will show you a few ideas how to use multiple time frames. So I'm not saying that this now what I will be showing you is this is the system or how you should do it, but this is definitely what you should be paying attention to and what you should be concentrating on if you want to experiment with this knowledge. Okay? Start with daily to capture the trend, move to 4 hour to grab the momentum, switch to 1 hour to cherry pick the entry. Or you can start with 4 hour to capture the trend, move to 1 hour to grab the momentum, switch to M15 to cherry pick the entry. Indicators which you can use are 200 EMA of a close. It's for capturing the trend. Stochastics 15.55 for momentum, and stochastics 533 or Fibonacci for entry. I will show you two examples which are different in showing you entries from using stochastics and using Fibonacci. The principle is the same. You need to align trend and momentum in the sequence. Sequence is either daily 4 hour, 1 hour, or 4 hour, 1 hour, 15 minutes. That is the sequence. Okay? Daily Australian dollar is bearish because the price is below 200 EMA. If the price is below 200 EMA, we qualify the trend as bearish. So in this example, the trend is bearish. Then we need to move on to 4 hour time frame to capture the momentum. We can see that I have chosen this candle as an example, and because of that I have put a vertical red line. Okay, so the momentum is to the downside. Why? Because stochastics are showing you nice two exact lines which are heading down from the top towards the bottom, and it's still they're still above 50. It's preferable. It's not obligatory, but it's preferable. And they're, look at this, they're pretty much diverged. They're not close, they're diverged. So they give you the momentum. They look like this. So momentum is to the downside. And now we need to see the entry. Moving on to 1 hour time frame, we need to see stochastics above 80 and then crossing below 80. So you need to see a stochastic cross below 80. So this light blue should be crossing. It's a signal stochastic line, should be crossing thick blue, and at this point, this is the candle where we can opt for a short trade. Okay? This is the entry if you use stochastic. Now, other example is using Fibonacci for entries. So same multiple time frame analysis applies daily 4 hour, 1 hour sequence. I say it again, you can also go with 4 hour, okay, 1 hour, 15-minute sequence. Okay? USD Japanese yen is bullish. Price is above 200 EMA on daily. This is marked candle on daily. Momentum here is to the upside. Okay? Look how those two lines are converged and they're both heading from the bottom towards the top. It looks like they started to fly. So the momentum is bullish. Entry. If this is the swing low, we have marked the swing low and swing high. Okay? Now we need to wait for our entry. We can put a trend line. We can see also that this level is very close to trend line and it's actually 50% Fibo. So when this level is hit, we can opt for a long entry. So these are the ideas which you can use yourself to build MTF trading system or trading charting method. And definitely, guys, if you opt for using Fibonacci, you will be using a price action more than indicator-based entry, which is, of course, stochastic. So once more, I will go through these slides, and we are already close to the finish of the webinar, so if you have any questions, do not hesitate to ask me. The idea is, of multiple time frame analysis, the idea is to capture the trend, the momentum, and cherry pick the entry. You don't need a lot of indicators. You need to see the trend, momentum, direction. Okay? Start with daily to capture the trend, move on to 4 hour to grab the momentum, switch to 1 hour to cherry pick the entry. Or start with 4 hour to capture the trend, 1 hour to grab the momentum, 50 minutes to cherry pick the entry. This is the general idea. Always, always, always. Daily 4 hour, 1 hour, 4 hour, 1 hour, 50 minutes. And 30 minutes is only a halfway to 1 hour, so it's not of a good use. That is why M15 is better. It's 4 hour the next time frame, which is 1 hour. And 4 hour is basically 4 1 hour time frame. So it's always 4 hour bigger time frame. 200 EMA for trend. Stochastic 15.55, but you can experiment with this. I always say this is general idea. You can experiment with these numbers definitely to see how it behaves on various pairs. But 200 EMA is fixed. This is the best indicator for MTF analysis. And price really tends to react strongly at 200 EMA. Stochastic 533 for entry or Fibonacci. Start with daily or 4 hour, doesn't matter. Capture the trend. The trend is to the downside because the price is contained below 200 EMA. 4 hour is to the downside because the price is below 200 EMA. Yeah, this is also important. Price is below 200 EMA, but also stochastics are going down. They're trying to reach the bottom, basically diving from the top. So this was the cross, and look how converged they are. So bearish momentum. Entry is when stochastic goes above 80 and then crosses thick blue line below the 80 from top to bottom. Okay, this is the cross. The closer to 80 it is, the better the entry is. But of course, I say you can experiment with these numbers. Same applies for Fibonacci entry. Daily is above 200 EMA, so daily is in uptrend. We are looking for long entries. We have momentum here. this is flying up from the bottom towards the top. So we have, look at this, this is bullish momentum. And entry, we draw Fibonacci from left to right and try to spot some confluence. We can see a good confluence here. Trend line, previous top, and 50% Fibonacci. Fibonacci levels are the most important here. Okay? So guys, this is the general idea, and we will have more webinars about multiple time frame trading and analysis. So feel free definitely to experiment with numbers and to experiment with your entries on demo platform, of course. Jose is asking, can I review the lesson? What do you mean by reviewing the lesson? This webinar should be uploaded, and this webinar is being recorded, so I think in next few days it will be uploaded, so you can definitely review the lesson online. So I guess that is the answer to your question, Jose. Yeah, it should be uploaded. So, guys, if you don't have any questions, yeah, I wish you a great evening. Thank you for the webinar comments. We will be here with you soon. Sign up for live training lab with Chris, and definitely also for a weekly Forex recap, where we will make another good week, hopefully, for our 5 different pair setups. Thank you for listening, and we will be here with you soon. Cheers and trade safe. And yeah, sign in for supply and demand webinar on Sunday. That is premium webinar. We'll be talking about supply and demand, and I will be giving you indicators about supply and demand. I will show you how to trade supply and demand. Okay, so sign up for that also. Cheers.